Helen, everyone talks about the 20% down payment as if it is the only option, and it stops many from buying. What is the absolute minimum someone needs to buy a home today, and what are the hidden costs no one mentions?
Thank you so much for having me again. That is a very good question. A lot. Just kidding. So, down payment to buy a house. This is your biggest purchase, most likely in your life, is your house. Minimum down payment needed is 5%,
Okay.
but you may not qualify for that. Every person's situation is different, but the minimum requirement is 5%. And that also depends on the property and your situation. So if we're talking about new Canadians, if you're new to Canada and you're here on a work permit, then you may qualify for 5. You might have to do 10%. You sit down with a broker and we look at your situation. The reason for the difference in the down payment for different scenarios is, what are you buying? Are you buying a primary residence? Are you a Canadian citizen? Do you have a PR? How long have you lived in Canada for? Are you buying an investment property? Are you buying a multiplex? Right? Every situation requires a different down payment. And you might be surprised at some of the answers that I'm going to talk about today. And down payment is not the only thing that you need to save up for. There are also what we call closing costs when you purchase a home, and they do vary per property. And I want to touch base on those because that's a lot of money too. It's not just the down payment. The closing costs are a lot of money. So let's start with the most basic, 5% down payment, minimum requirement. You're either Canadian citizen, you have good credit history, you qualify under the most basic rules. You are on PR and you've been in Canada for at least 12 months. You're on a work permit and you've been in Canada for at least 6 months. For at least 12 months as well. Or you've been in Canada for several years and you are still technically under New to Canada, even though you qualify under certain other rules. You might still have to qualify under a new Canadian. So let's talk about the 5%. With the 5% down payment, it's the easiest one, obviously. It's 5% of the purchase price. And then anything on top of that, we consider closing costs. So what are closing costs? You pay your land transfer tax, which varies by province and by municipality. Your realtor will tell you what the closing costs will be. A good realtor will tell you what the closing costs are. You have your land transfer tax, your lawyer fees, you have property taxes, you have other fees like title searches, all related to legal cost. When you're thinking of just down payment, you're thinking, 5%. Okay, that's not that much. Let's say you're buying a house for $500,000, you need $25,000 down. Okay, I have that. What about closing costs? You have to show the bank that you have closing costs. Now, because we do the stress test and you have some room there, let's say you're buying a house, you're not maxing out your budget on paper and you're buying it a little bit less, we could say you can use your credit cards for the closing costs. How much are closing costs? They vary. So what a bank wants to see is at least 1.5%, which only covers land transfer tax in Nova Scotia. If you are buying a property and you're not going to live in this province, your land transfer tax is going to go up. If you're a non-resident, that goes up again. So it goes from 1.5% to 5%, then to 10%, right? There's a huge difference. That's a lot of money.
Almost 10% if you are on the minimum base.
Yeah, that's a lot of money. And so you have to look at that again, sit down with your broker and see which category you're in. If you're buying a house in Nova Scotia and you plan on moving within a certain time frame, you could still do the 1.5%. That is a conversation we have with the lawyer as well to see how we fit into that as well. So with 1.5%, that just covers land transfer tax. What else do you have there? You have property taxes. Depending on the municipality, you get your tax bill normally twice a year. I'm going to use HRM as an example. Our tax year is from April to April. So our bill for this year is already paid. We had our bill from April of 2024 to April of 2025. And the next bill's year is going to be from April 2025 or 2026 to April of 2027. So most people have already paid their property taxes for this year. But if you're buying a house right now, how we do this is the seller pays from the beginning of the tax year up until the closing date of when you actually take possession of the house, and you pay the property taxes from the closing date until the end of the tax year. So even though the seller's already paid for the property taxes, you're still liable for your portion, and they get reimbursed for it actually, because it's your house, you own it now, so you're responsible for the taxes. If there's any taxes in arrears, they have to pay that up. That's not coming out of your expenses, and that is something that your lawyer breaks down for you in a trust ledger or a statement of adjustments. That is something that you'll see on paper from a lawyer, and they normally tell you this as well. Other legal fees, obviously, you have lawyer fee. It could be $1,000, it could be $2,000. Really depends on what your lawyer has to do for that specific property. If you're doing home inspections, or appraisals or any other type of inspection, you could be looking at another couple of $1,000, because if you want to do a home inspection, it could be $400, $500, depending on the square footage of the house, the type of home. If you're doing septic and well, for example, if your house is not on municipal water and sewage, you want to do the septic and well, those are another couple of $100. So there's another grand right there. So on average, I would say closing costs will range between 2.5% to 3% on top of the 5% down payment. Some of those can be covered with your credit card. The majority of that, the bank will want to see the 1.5% for you to have out of your own savings, unless I say otherwise, because you can afford it to put on your credit card, for example. And that is a whole other scenario. But you do want to prepare, because that is money you're going to have to pay back off your credit card, right? Mm-hmm. So, when you're looking at the minimum down payment, it's not 5%. You're looking at like 7.5%, 8% minimum.
Probably 10.
Okay. Well, and then the other thing is, of course, moving costs, yes. Right? Heating. So the seller, if your heating is on oil, which is very common in Nova Scotia, they'll fill up your oil tank or your propane tank. But then the next month, that's on you, right? So that's not going to last too long. So you want to prepare to fill that up. And you have your moving costs, your furniture, whatever else that you have to do. You might be taking time off work to move, so you might have some wage loss. There's a lot of things for you to consider with buying a home in terms of the actual cost. But I will say probably 8% would be the minimum that you should be considering that you need to feel comfortable without trying to put anything on your credit cards. The next one is 10% down payments, which is the second most common. Who is that for? That is for people who are buying properties that are 2 units or more. So it could be a 3-unit place. You're moving into one side, renting out 2 other units. Sometimes the banks will ask you to do 10% down payment if you're buying a 2-unit place. Sometimes if you're new to Canada and you don't qualify under the regular credit rules to, you're not showing enough credit history or income history here, they will say, okay, well, if you want to buy a house here and you've lived here for 6 months, you have to do 10% down. If you are going under a specific program, so for example, there's a stated income program for self-employed people who are buying a house, your minimum down payment will be 10%, right? To just qualify for that program. And there's other programs like that, but they want you to have more down payment because it's higher risk for the banks. So that, again, and that does include the closing costs, which are the same thing, 1.5% plus give or take 2.5%, 3% for other fees. So that is the second most common one.
If you are finding this helpful, subscribe now to access our complete series of Canadian mortgages and master your home buying process.
You do 15% down payment when you're buying, either because you want to or because you have... you're buying a multiple unit property. So normally 15% down is needed if you're buying a 3 or 4 unit property.
Or it happens as well when you are buying a house that is value more than 800,000, right? When you are buying an expensive house.
So it's not as common. It's not as common as it was during COVID, but it's still happening right now. Basically, if you're buying a house that for, let's say 600,000, but it's not worth that much. Let's say the bank wants to do their own assessment on the property called an appraisal. An appraisal is a legal document that is done by a professional that is used to calculate the value of your house in real time based on the current sales, the current market, and what's sold in the area within 6 to 12 months. That's similar to your property. So they look at a property that's worse than yours, that's the same as yours, and it's slightly better than yours. And then they calculate that and say what your house is worth. So for example, the bank thinks, okay, there's no way this house is worth 600,000. They'll come in, they'll do their appraisal, they'll say, okay, this house is only worth 500,000. Then you're going to have to make up that difference or to go back to the seller and negotiate and say, you know what, I put in a 600,000, but the bank says it's only worth this. And then we're looking at different down payment, but it's not 15%. You actually have to make up the difference. If you still want to buy the house for 600,000, you either have to make sure you qualify for 600,000 purchase price and do the slightly higher down payment. But if you don't, you have to make up $100,000 in difference. That is a whole other topic.
A lot of money.
It's a lot of money, yeah. It actually happened a few times for my clients during COVID. And sometimes they just didn't care because they were moving from Ontario and Vancouver where they made a ton of money, and 100 grand for them here didn't mean anything. Unfortunately, it inflated the market.
Yes, it happened. And now everything is expensive.
It is, yeah. And I feel that's definitely a different topic of conversation. It's not about down payment at that point. It's about inflating the real estate market. The next one I think is 20% down, which is if you're buying a rental property or if you don't qualify under the regular insurer's rules, because as soon as you get a mortgage in Canada with less than 20% down payment, you automatically have to pay into mortgage insurance, which I will talk about because it's technically part of down payment and it's not. So mortgage insurance is insurance that the banks take out against you. So if you default on the house, you don't make your payments, you go into bankruptcy, they're covered by insurance, but you pay for it, not the banks. And the percentage that you pay into insurance changes with the down payment. So there's a scale and we could tell you what those numbers are, and that number is going to be on your mortgage contract. But I'll give you an example. If you're buying a house with 5% down payment, which is the minimum requirement, your mortgage insurance is 4%. So really, you're only putting 1% down payment into the house at the end of the day. Your mortgage, that insurance is added to your mortgage. So really, it just looks like you only did 1% down payment, and your interest is, you're paying the interest over the period of time. There's no way to get rid of it. There's no way to pay it off early. And if you sell the house, you can't transfer that insurance. You can't do anything with it. Unfortunately, that is how it works in Canada. There's nothing that you can do about it. You could do 20% down payment and not pay that insurance. That's the minimum requirement. Your interest rates are going to go up because you're highest risk then. You don't have default insurance. So if something happens to you and your house, the banks can't take out insurance on you. You do 20% down payment, which is the minimum to avoid that insurance. You're at the highest risk marker. So they increase the interest rate because you're high risk for them at that point. Why do people do 20% down payment? To avoid paying for that insurance. I always say if you have that, pay it. You're not going to save any money on interest rates because they're only slightly higher. It doesn't make any difference. And even if you do 20% down, you could still pay into that insurance premium. It's just going to be a very small amount, right? You're not paying 4%. It's closer to 1%. I don't know the exact numbers, but there's a scale that we calculate that based on down payment. So that might make more sense for you. And how I calculate that, if it does make sense, is I look at your interest rate over 5 years. So for example, if you take a 5-year fixed term, insured or uninsured, I'll say, you know what, you're better off paying a little bit into the insurance premium to get the insured interest rate, because over 5 years, it will save you $1,000 or something like that. Right now, with the interest rates where they are, it's not a huge difference, but I will say during COVID, when people had the insured rate versus uninsured, it was quite a big gap between the two. And most people were willing to put 19% down, paying a little bit into the premium. And then they knew that over the 5 years, they would save quite a bit of money. It really depends on the time of the market and the scenario. But yes, it is technically part of the down payment, because when you look at your first mortgage statement, you're thinking like, oh my gosh, I did 5% down. Why is my mortgage so high? You really only did 1%. So your payments are based on that as well, right? And that is part of how we calculate what you can afford, because that's calculated into that as well, right? With 20% down, you do avoid that. The rate is slightly higher because you're high risk, but it puts you into a completely different category. So if you have that kind of money and you don't qualify with a regular bank, you come to a mortgage broker, because we have so many different lending solutions for you. I talked about in the previous episode about how banks qualify you versus how a mortgage broker does, and how different lenders have different thresholds of risk. And so that is why, because if you have 20% down payment, you qualify under different threshold of risk, and I have more lending options available for you. Most investors, most people who want to avoid insurance, or people who have been in the real estate game for a long time, will try to do the 20% down payment, because they have more options for what they're looking to buy.
That's very interesting, because you may think that you only need a percentage, a fixed percentage of the buying cost, but when you go deeper, it's more. So I think that the most important thing here is that the people who is listening to us, they should contact you in order to have a concrete and a real assessment according to their situation. So what is the best place for them to contact you?
Can reach me on my phone at 902-237-1112. You can look me up on my website at gondamortgages.com, or you can contact me via email or through the podcast. Leave a message and we'll reach out to you. Thank you so much.
Thank you so much, Helen. Is there anything else that you want to share with us today?
I want to say that it is very important to talk to somebody instead of just doing an online application. I see a lot of people making the mistake of thinking an online mortgage application or pre-approval. A pre-approval is what you use to see what you can afford for a mortgage before you go house shopping with a realtor. If you do it online through an app or banking app or a mobile app, whatever it is that your bank is offering you, you're not getting anything accurate. I could talk for hours about proper qualifications and document proof, which with me, when I do a pre-approval with a client and make a plan for them, it's not a 5-10 minute thing, right? It takes me hours to put this plan together. I might have a meeting with a client for an hour, but then in the background, I am doing research, I'm gathering their documents, I'm talking to lenders to see what their options are. It actually takes me hours to get them a proper pre-approval. And I even submit an application to a lender and say, hi, can you look at this? Would you take this if it's a weird scenario? If it's not a conventional mortgage or a no-brainer application, I'll go to the lender and they'll say, hey, can you look at this for me? And they will do that. They'll say, yes, yeah, we'll work with this if they do this or that, right? An online banking app is not going to do that. If you go to a bank and you talk to your mortgage advisor and they sit with you for 10 minutes and take down the basic information, that's not a true pre-approval. You're never going to get anywhere with that.
And it can change.
That is
right?
absolutely, yeah.
Yes, you may say I have 200 or 500,000 available, but when you go forward and you want to buy the house, you don't have that amount at the end, because they will run a special test with all the information, with all the procedures, and then you will have the exactly amount that you can owe. Is that correct?
Yes, and so the issue becomes is when you, let's say, do a quick pre-approval and the app or the person that you talk to says, oh yeah, I think you'll qualify for $500,000 mortgage. You go with your realtor because you talk to somebody, you think you have a legitimate pre-approval, you put in the offer gets accepted. That is the worst, because then you go to the bank and you have a certain amount of time to meet the financing deadline to get approved for the mortgage, to get that money. Normally it's 10 business days that they allow for, depending on the realtor. But let's say it's 10 business days. You go to the bank, it takes them a week to tell you that oh, sorry, you don't qualify. And then you're wondering, oh my gosh, well, I just did the pre-approval with you. And they say, well, no, it's more like a pre-qualification based on what it's a recommendation of what we think you actually could do, right? Not an actual legitimate pre-approval. And the difference is the pre-approval process is step one in submitting your application to a bank. It's the same process I would do. And it differs from broker to broker. Some brokers do it differently. I do a full-on application with the client as if I'm ready to send it into a bank. And sometimes I will reach out to the lender or the bank and I'll say, hey, can we do this? Because I'm not too sure about this person's scenario, right? It's never black and white on a submission, on a pre-approval. And people can lose up money on their deposit, right? You could think you're approved for financing or even waive financing with a seller. And then you come to find out you can't afford the house, you can lose out on a deposit.
That's very
Quite a bit of
important. I
money.
think that you can come again and talk about that because it's very important. And I heard many
Yeah.
things about that. For example, that when you go to a bank, you get a credit score check. But if you go with a mortgage broker, you get one. But that score check works for many lenders. So I think that you can give us a lot of information about this topic. What do you think about?
Absolutely, I would love to do that.
You have the down payment ready, but what if you combine forces? Click here to learn how buying as a couple can significantly boost your borrowing power.